The unstoppable rally continues. Live from New York City this morning. Good morning, good morning. Your S&P 500 positive by 0.2%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Ferro.
Live from New York, coming up, Fed officials struggling to put a dent in this rally, shipping in the Red Sea grinding to a halt, and Apple just days away from a U.S. watch ban. We begin with the big issue, conflicting messages.
We weren't talking about rate cuts at all.
Rate cuts are in the discussion.
We're not promising rate cuts.
It's difficult when you've got the chair with a very, very dovish message and then members of the committee are walking it back.
You saw some pushback.
Fed speak push back on some of the moves in the market.
Folks coming out in the days after saying maybe people need to reconsider.
Saying that the markets are being a bit presumptuous.
The market's already well ahead of the Fed.
It has been an absolutely enormous rally here.
Bonds and stocks alike have trimmed the tree. They popped the champagne cork for New Year's. They booked a ticket for summer vacation.
Where did all the bears go? And I think we know. The Fed shot them.
Powell himself had the chance for pushback in his speech, and he didn't do it.
He has to be very careful.
Fed officials were sort of paraded out and say, stop this and make sure you get the right message out.
The message for markets is, don't get ahead of yourself in expecting a huge number of rate cuts in the first half of 2024.
This market is getting ahead of itself. Let's have that conversation right now with Mohammed Al-Erin of Queen's College, Cambridge, with us in the studio here in New York City. Mohammed, great to catch up with you as well, sir. Let's start with this. We're stuck on Wednesday. Never mind the fact that it's Tuesday, we're still talking about Wednesday. What happened in that news conference with Chairman Powell last week?
Total confusion. And the fact that you start a show on Tuesday talking about confusion from last Wednesday is an indication of how absurd this whole situation is. John, the whole point of Fed communication is to do two things. One is to be transparent, and two is to enhance the power of forward policy guidance. Instead, Fed communication confuses people. Fed communication fuels moral hazard. How often did you hear the Fed put is back? And it erodes the credibility. I think we have a real problem with Fed communication, and the market is absolutely correct in trying to do two things. First, in trying to bully the Fed, because this Fed seems to be willing to be bullied. And secondly, to get carried away with this notion that the Fed put his back.
Let's go back to the comments from Chairman Powell in the news conference, Mohammed, and work through them together. Here was the quote. The question of when it will become appropriate to begin dialing back the amount of policy restraint in place is clearly a topic of discussion now for the world, and also a discussion for us at our meeting today. Did you find that confusing, or the comments we've had since then confusing? Which one?
So, like everybody else, I think you put more emphasis on Chair Powell's comments, and that's what the market has done. If someone was with him that understood how the market would react, they would say to him, whoa, be really careful, because the way you're going to be heard may be different from how you want to be heard. You're going to be heard as opening the door wide open to a major rally in both fixed income and in equities. You know, in the old days, you had people like Kevin Walsh, who would be in touch with the markets, who understood how the Fed would be heard, and who was a moderating voice in terms of let's ask the question, not what do we want to say, but how will we be heard. We don't have that. And John, this other confusion, you have now two-pronged communication reaction. One is to walk back what he said, and the other one is to explain what he said, right? You can't do both at the same time. You've got to decide, are we walking it back or are we explaining it? Now we're getting both.
So we've had plenty of pushback, not just from Fed officials, but from people writing columns, including yourself, Mohammed. Bill Dudley, former New York Fed president, said this was a big gamble, this apparent pivot. You've said the market shouldn't be being bullied, or rather, the market shouldn't bully the Fed. Now, can you explain to me just that headline on the market bullying the Fed? How is the market bullying the Fed?
So what the market has done, and we saw it in January of 2019, we saw it happen in April of 2020, we saw it happen in November of 2021, is that every time the Fed goes towards the market, because there's a decoupling, the market runs away further from the Fed. And the market has understood that it can drag the Fed along. And that's got to stop, John, because we get overshoots, and then we've got to pay for the consequences of those overshoots later on.
In the piece in the Financial Times that you wrote earlier this week, there was a quote at the very top of the article. It read as follows: "It turns out that inflation was transitory after all." That's some of the language being used out there at the moment, Mohammed. Why is that the wrong conclusion?
Yeah, so I used that quote and then pushed back on it immediately, saying not only is it analytically incorrect, but it is dangerous. Why is it analytically incorrect? A transitory phenomenon is temporary, it is reversible, and therefore you look through it. You don't change your behavior. Massive behavioral changes have resulted over the last few years from inflation that was too high, starting from the Fed itself having to tighten, but we've seen also the banking issues. We've seen what's happening to commercial real estate. There's been major changes. So to call inflation transitory after all is to ignore that the landscape has changed because of inflation. It's also dangerous, John, because it opens the door to this notion that we're going back to a rate structure that is very artificial. We're not. We're going to settle at a higher average level of yields than we did after the global financial crisis. And we shouldn't fuel this notion that we're going back to what followed the global financial crisis. We are living in a world of inflexible supply side. What's happening in the Red Sea is another illustration of that. And we've got to recognize that we're no longer in a world of insufficient demand. We're in a world of insufficient supply.
We'll get to the Red Sea and the Suez Canal a little bit later in the hour. Let's just pick out one part of the economy, Mohammed, together. Let's go to the labour market. Haven't we learned from this cycle so far that this labour market, the characteristics of it, aren't a threat to price pressure?
Yes, because the supply side has been responding. It took time, but it's lovely to see people going back into the labour force. Having said that, John, we're still in the middle innings of the labour market. So let's wait and see how that evolves. But the good news, and we should all be encouraging this, is that more people have entered the labour force.
You think it's wrong to assume that supply side-led improvement, rebalancing we've seen won't continue?
I think there's a real question about skill mismatches. There's a real question about how far you can increase labour force participation. My hope is that it will continue, but you need to wait and see.
So we've had massive easing in financial markets, financial conditions over the last 2 months, both in equities, credit, and also in the bond market as well. Yields aggressively lower. What's the price we're going to pay for that, do you think, the moves we've seen in just the last 2 months?
Yeah, I mean, first, the easing has been historic. Lisa put out a tweet before Chair Powell turbocharged this whole thing, showing that financial conditions were looser today than they were when the Fed started hiking. And then they've loosened significantly since then because of the way the market interpreted what Chair Powell has said. What's the risk, John? The risk is that they're loosening too quickly and too much, and that in itself will mean that the last mile of the inflation battle, which was complicated to begin with, gets even more complicated.
Why does it have to be complicated? We've heard from many people who think maybe the hard work is behind us. Jan Hatzius, Goldman Sachs, talked about that in his outlook for 2024. And I think we're hearing that from Fed officials as well. Yeah, perhaps this last mile doesn't have to be that difficult. Secretary Yellen even weighing in on it as well. Why do you disagree with them?
So first of all, it depends how you define the last mile. If you define the last mile how I would like them to define the last mile, which is de facto or implicitly target a higher inflation rate, it doesn't need to be difficult. And if that's what their thinking is, I very much applaud that, because there's no need to sacrifice the real economy in order to get to an inflation target that's not suited for the world we live in today. So if that's the interpretation, then I'm with them. It doesn't need to be complicated. It doesn't need to create damage. If the interpretation is we're going to get to 2% without causing problems, I just don't see it. Look at the inflation dynamic. Look at what's happening. You would need service disinflation to massively accelerate, because outright goods deflation is going to stop at some point. And it's very difficult to get service inflation down using interest rate policy alone.
So do you get the sense this Fed is accepting 2 point something for inflation and not 2.0?
I think they're heading that way, John. Yes, I do. I think they're heading that way. They're never going to say it, But I think they're recognizing, and the new emphasis you're starting to hear, and you heard it today from Mary Daly, the president of San Francisco Fed, saying basically we don't need to sacrifice the real side of the economy.
Heard that in that interview with the Wall Street Journal. Mohammed, stick with us. I'm pleased to say he's going to be with us through the hour. Your equity market open in about 20 minutes' time. Equity futures right now on the S&P positive by 0.1%. With some movers going into the open, let's say good morning to Abigail.
Good morning, John. Let's start out with the shares of Kenvue. This spin out from J&J popping by about 6%. This as a court ruled in the company's favor in a class action lawsuit related to Tylenol. Analysts, however, are saying that some caution may still be warranted because there could be a lengthy appeal process. Chewy up 4.5%. Jefferies initiates with a buy rating and a $27 price target, suggesting that some nice potential for price appreciation could be ahead. They're saying the company is positioned well for an inflation and a period of trading down in pet food. And then finally, Accenture, the technology consulting company, it maintained its fiscal year earnings forecast, but that's below the street for a stock that's up 28% year to date. Investors wanted more.
Abby, thank you. Coming up on this program, equities heading towards all-time highs.
I think equities have a ways to go, and I think you could see them test and challenge and surpass the old highs. That's always been our call.
That conversation up next.
I think equities have a ways to go, and I think you could see them test and challenge and surpass the old highs. That's always been our call. Even if you do end up having a recession, markets always hit a new all-time high before they do that. So I think there's a much better risk return in equities right now than there is bonds, and that's different from a month ago.
The Fed just can't put a dent in this market rally. The S&P 500 heading towards all-time highs with an 8-week winning streak now a possibility. The Nasdaq hitting a record of its own on Monday for a second consecutive session. Bloomberg's Katie Greifeld joined us now for more. Morning, Katie.
Morning, John. Yeah, when it comes to the S&P 500, we are just inching and inching closer to that all-time high. To go through some of the numbers right now, the benchmark closed at 47.50 yesterday. Its record closing high is about 1% away at 47.96. That was reached in January 2022. So quite a while ago, but we're just a hair away here. And like you said, it's been a very consistent climb higher, 7 straight weeks of gains and a real broadening out. If you take a look at the sector breakdown over the past 2 months or so, real estate is at the top of the leaderboard with a 17.5% gain, closely followed by consumer discretionary, higher by nearly 15%, and then tech following in third place. And that's a real regime shift from much of 2023 when it felt like tech and AI optimism was really dragging the index higher against its will. But now, following that huge plunge in yields that we saw, growing conviction that the next move from the Fed will be a cut maybe sooner rather than later, it's those real rate-sensitive sectors that are shining. Even still, though, it's hard to fight the influence of mega-cap techs. Despite that improving breadth, you take a look at the S&P 500 equal weight index, it's still lagging the S&P 500 year to date, despite outperforming over the past 2 months. And while the S&P 500 just a whisker away from that all-time high, the equal weighted index still has a lot of ground to make up, John.
The S&P getting closer and closer. Katie, thank you for that. Michael Hartnett over at Bank of America capturing this almost perfectly in a survey of global fund managers showing the most upbeat sentiment since January 2022. Investors expecting a Goldilocks environment in 2024, bolstered by expectations of Fed easing. Joining us now to discuss, John Hancock's Matt Miskin, JP Morgan's Monica DiCenzo, and Mohammed Al-Erin of Queen's College, Cambridge, still with us. Monica, I want to come straight to you. How expensive is that soft landing hope dream, that story for next year? How expensive is it now?
It's been funny to watch markets. You know, sitting here a year ago, everyone was so paranoid and scared about what they thought was going to be a recession that was a sure thing. And now fast forward, equities are up 20%, and now everyone's crippled because they think things are too bullish and they've missed it. And so for clients I work with, what's really expensive is to sit in cash and keep watching the next phase of this cycle. And so we've been really focused on how to get invested, make sure you're still meeting the goals that you've outlined, because sitting in cash is not going to do it.
Matt Miskin, what are you telling people?
Yeah, things have gotten expensive. And over the course of the year, we've gotten almost 20% of the return from multiple expansion. I wish that multiple expansion just could continue into next year, but it's going to be hard to do. We're at about almost 19 times. The July high was about 19.5. You know, Albert Einstein said that compound interest was the seventh wonder of the world, not multiple expansion. So we want to actually find places to get income into next year. We want to make sure we're compounding interest, staying invested. We have played the quality factor in the U.S. over the course of the year. That has done well for us. But frankly, we're looking to trim some risk into next year.
So Matt, speak to Monica's point about people feeling uncomfortable in cash. What do you say to clients that say, you may be right, but the alternative is worse?
So we're looking at locking in those rates for those clients, and we actually see more of a disinflationary environment into next year based on the housing data catching up from that lagged effect. And we actually think that the bond market is a better place to lock in higher rates for longer. I know that the bond market has priced in a lot of rate hikes in quick order here from the Fed pivot. But in our view, that's where you want to be for that kind of capital. On the equity side, we're just trying to find more defensive, higher quality businesses to be long-term investors. But frankly, earnings growth estimates look high, multiples look high. So we want to find cheaper parts of the market that offer us better return potential.
So Monica, based on that, you hear a lot of people saying high quality bonds are win-win. You get good income, and if, God forbid, we slip into recession, you'll get the price appreciation as well. What do you say to those people who say, from a risk-return perspective, high-quality bonds are a better place to be?
I think that's a fair assessment of the market. Again, the challenge is, what is the goal I'm trying to achieve through a cycle and long term? For most clients I work with, a 90% bond portfolio is not going to get you there. So it's about finding the right places, to Matt's point, to add risk in a thoughtful way. I'm not afraid of equities, but I do think you have to be eyes wide open. It's no longer just a beta trade. You have to pick some of your spots. One thing I would highlight, in spite of this rally, volatility is very low. People are getting nervous to add. If I were adding here, maybe I'd overlay with some hedges, because I do have that bond portfolio throwing off some good income. I can buy a little insurance. And to me, that's probably a better balanced way to think about your risk than to be all bonds or all cash right now.
Can we talk about the correlation between bonds and equities at the moment, Monica? Is there any reason to believe that's going to change in the next few months?
I mean, I think it's a macro question, right? So it certainly could. And I think when you start to see these cuts play out, if they do play out, bonds will eventually look relatively less attractive. And maybe that's the world where if they can navigate the soft landing, then it's a green light again across the board for equities. But again, like many clients I work with are so scarred from what happened over the last couple of years when you had equities down and bonds down, that they're a little skittish. And so it's, again, about finding the right balance and being really thoughtful when you're leaning in, especially if you're someone today who didn't participate in this rally. It's going to be hard to get people over that line. And so we're just trying to find ways to, most importantly, move out of cash and take a little bit of risk again.
Matt, how do you answer the same question?
Well, one, I would say every time that the 60-40 portfolio is forecasted to be dead, it comes back alive. And November was one of the best months for a 60-40 portfolio in the last several decades. Now, it is all one big trade. It is, my colleague Emily Rowland came on and talked about the pivot party, and every asset class is invited to the pivot party. And so everything in a portfolio is going up. In our view, that is not sustainable. Different parts of a portfolio, different asset classes have different attributes. High quality bonds should not be acting like regional banks. They should be inversely related because the fundamentals dictate that. Eventually, we do think that comes into play into next year. Pivot parties are a late cycle phenomenon that usually do add risk, but then subsequent to that, the fundamentals, whether it's earnings or macro environment, becomes bigger factor in time. We think that's the story of 2024.
Monica, you mentioned some of your clients still being scarred. Help us understand a puzzle. One of the asset classes that hasn't seen inflows in recent weeks, in fact, has continued to see outflows, is emerging markets. And that's despite a higher average quality, that's despite less leverage, that's despite a cleaner technical background. Are your clients simply too scarred to go back into more peripheral asset classes?
Yeah, I think there's no doubt there's a value argument to make for emerging markets, equity and credit. The challenge, though, and I saw this coming out of COVID, people said, you know what, I'm scared about the world. I don't understand what's happening. And if I have to go back into risk assets, I'm more comfortable in the US, kind of what I know better, just feels a little bit safer. Now, doesn't mean that's the right answer. There's a psychology versus what we theoretically would all do from a market standpoint. For me, again, talking to clients, I just want them to add risk. I would love if they were more diversified because so many were very US focused, and you've seen real pockets of brightness across international markets. But my first and foremost goal is get out of cash, go a little out in the risk spectrum. If I can get you there, then yes, I would love to see you more diversified. But that's sort of the second iteration in most of the conversations I'm having.
Hey, Monica, appreciate the update as always. Monica DiCenzo there alongside Matt Miskin. Mohammed, let's build on that just a little bit. EM. I think there's a massive home bias right now here in the United States. Growth is okay, inflation's coming down, rate cuts seemingly are just around the corner. Why wouldn't you stay here? Why would you go abroad right now?
Because there's more value abroad. You've seen this in local currency, in EM. The asset class has been abandoned by quite a few investors. As I mentioned, speaking to Monica, it continues to suffer outflows when other asset classes have suffered inflows. I mean, we call it the everything rally, and EM has rallied, but it hasn't changed the technical dynamics. So I find it quite interesting. There's a lot of conversation going on. Is it structurally damaged? Is it the way EM is managed? But if you compare like for like, there's a valuation advantage that isn't being exploited enough in EM.
We'll see if rate cuts are a catalyst for change, a change of attitudes towards emerging markets in the year to come. I'm pleased to say Mohammed's going to stick with us. Coming up on the programme, the morning calls, and later, Oppenheimer's John Stolfus on why positivity at the end of the year should mean more good news next year. One of the biggest bulls on Wall Street around the opening bell. Your opening bell is 7 minutes away. Equity futures on the S&P just about positive. 5 minutes away from the opening bell. Outperformance again on the small caps. The Russell up by 0.75%. That's the price action. Here are some morning calls. Your first one from Bank of America, raising its price target on Costco to $7.40 from $6.55, seeing the company's value proposition as more attractive for consumers, adjusting to higher prices. Your second call from KeyBank, raising its price target on Uber and maintaining an overweight rating, citing stable trends in ride-sharing market share, intent to increase trip frequency and food delivery adoption. That stock is just about unchanged. And finally, JMP Securities raising its price target on Lennar to 170, pointing to stellar fourth quarter earnings thanks to a boost in deliveries. That stock is up by about 1.1%. Coming up on this programme, Oppenheimer's John Stolfus on why he sees support for stocks heading into 2024. One of the biggest bulls on Wall Street is just around the corner. Your opening bell is up next. We are already on the longest weekly winning streak since November 2017, 7 weeks of it. Here we are week 8, and the rally just grinds on. Equity futures on the S&P up by 0.1%, on the Nasdaq up by 0.1%. Take a look at the Russell, the small caps up another 0.75%. There's your opening bell. Switch at the board and get to the bond market. Yields look like this on a 10-year this morning. Yields are lower by almost a basis point, 392.19. Remember the levels of late October through 5%, now south of 4. It's a move of more than 100 basis points lower. Equities rallying, bond markets rallying too. In the FX market, the euro shaking off some bad data, 109.67. Stronger euro against the weaker dollar. That currency pair positive by about 0.4%. Lots to talk about in the Middle East. Specifically, what's happening with the Suez Canal and the traffic going through the Red Sea and what it means for this commodity market. Crude up by 0.5%. WTI $72 and about 83 cents. About 35 seconds into the session, equities advancing by just 0.15%. On the Nasdaq, up by 0.21% on the Nasdaq this morning. Record high after record high on the Nasdaq 100. Can we add to that in today's session? One stock to watch at the open is Kenvue, the Tylenol maker, scoring a legal victory with a court ruling in its favor in a class action lawsuit involving the drug. Abby has more. Hey, Abby.
Indeed, John. And the stock today is popping as a result, up more than 5%. Its best day in nearly 2 weeks. And this lawsuit has to do with, it alleges alleges that Tylenol taken on a prenatal basis can cause autism and attention deficit disorder. On Monday, however, a federal judge granted the defendant's motion to exclude plaintiffs' expert opinions on whether that is in fact the case. JP Morgan analysts are saying that this is, quote unquote, a clean sweep for the defendants and that it, quote unquote, effectively collapses the plaintiff's case in the multi-district litigation. Other analysts, though, say that the possibility of a lawsuit dismissal, because Kenvue is saying that they are going to seek that the case is dismissed, reduces but does not eliminate the litigation risk, mainly because there could be a lengthy appeal process that could prolong uncertainty. On the year, John, this stock is now about flat from where it IPO'd this spring.
Up 5% this morning. Abby, thanks for that. Let's stick with pharma. Amgen upgraded to outperform at BMO Capital Markets because of its potential in the obesity drug space. Katie Greifeld on top of this one. Hey, Katie.
Hey, John. Well, when you mention obesity drugs, it's probably Novo Nordisk and Eli Lilly that come to mind. And that's actually at the core of BMO's Amgen upgrade. Taking a look at the actual note, analysts there saying that Amgen, quote, has unappreciated potential when it comes to the obesity drug market, and that the biotech's developing pipeline gives investors the opportunity to play in this space without paying the same premium that you'll find when it comes to Amgen's peers here. Now, as a result, BMO says that Amgen may be the 2024 value obesity play, which sounds a little bit like a curse given that value stocks can't seem to catch a break. Maybe Amgen will fare a little bit better here, but it's an important point. You take a look at shares, they're only about 5% higher in 2024. For context, you take a look at Novo Nordisk, currently sitting on 45% year-to-date gains. It's even more dramatic if you take a look at Eli Lilly, currently up about 58% year-to-date. So even a catch-up trade would be pretty powerful when it comes to Amgen. You take a look at shares, only about 1% higher right now, though, John.
Katie, thank you. Some of those names have just had a massive run through 2023, particularly Novo Nordisk. Let's turn to tech. Apple racing to tweak its smartwatch software just days ahead of a potential ban in the United States. Alex Webb joining us out of London for more on this story. Alex, great to catch up, buddy, once again. Just go through the latest for us and what's going to happen over the next couple of days.
So what we've seen is that the US International Trade Commission has imposed a ban on sale of the two most recent, most cutting-edge versions of the Apple Watch starting on December the 25th. And it all relates to the blood oxygen measurement feature that exists on those devices. There's a medical technology company called Masimo based out in California, which has successfully argued the case that Apple's technology infringes upon its patents. That is what has brought this ban into effect. So what Apple is going to do is they're going to stop selling these devices online in the US starting on Thursday and in their retail outlets starting on Christmas Eve. That doesn't mean if you're in the US you won't be able to buy this device if you really want it. You can still get it in Walmart, in Costco and other third-party retailers. But it's a bit of a blow to a device which analysts estimate generate about $17 billion in annual revenue for Apple. Some context to that, of course. Apple in total generates $380 billion in revenue. So while it is a meaningful part of the business, it remains perhaps just less than 5%.
Which explains why the move is pretty small this morning. Alex, thank you. The stock is up by about 1/3 of 1%. Let's turn to pet care. Those stocks moving after Jefferies initiated coverage on the industry, seeing potential for e-commerce sales, favourable customer metrics, and a whole lot more. Simone Foxman on top of this one. Hey, Simone.
Hey, John, many of these pet names have been really beaten down. You look at especially the retailers, the likes of Chewy, down about 80% since hitting a high at the beginning of 2021. Petco down about 90% since around then as well. This as folks got out of their homes, went back to the office, and were less likely to suddenly go out and adopt pets as they did during COVID-19. But Jefferies seeing a lot of positive signs for this market, talking about how average spend per household is up 60% since 2019, mainly driven by people buying higher quality products for their pets. So that's going to benefit names like Chewy, several growth and margin levers at its disposal, according to Jefferies. But it's not necessarily going to help folks like Petco, which is focused on a little bit more the value oriented of that play. But the real winner for Jefferies, as they initiate coverage of this space, is the animal health sector. So Pet IQ, for example, which distributes both top-end third-party medications, but also has its own in-house tick and flea medications. That's going to benefit. And Best in Show, Zoetis, the global leader in the $45 billion plus animal health market, they say. Those names moving a little less this morning, however, partly because they're a bit of a consensus view, whereas the retailers, including Chewy, up about 5%.
Best in show, very smart. Simone, thank you for that. Appreciate it. About 6 minutes into the session, here's the broader market for you. On the S&P 500, advancing by about 0.1%. Similar move on the Nasdaq. Outperformance again on the small caps. The Russell up by more than 1 full percentage point. The outlook is really constructive. Michael Hartnett of Bank of America, we mentioned the Global Fund Manager Survey a little bit earlier this morning. Just go through the headlines of that. That Fund Manager Survey, the most upbeat since January 2022. That was the last time we had all-time highs on the S&P 500. People are deploying capital. Cash levels have been cut to 4.5%. B of A says that's a 2-year low. Just 2% of investors, 2%, just 2% of investors expect higher rates. 18% looking for higher yields in 2024. Oppenheimer's John Stolfers feeling optimistic about 2024, writing this. Comments from officials at the Federal Reserve, along with positive economic data and better than expected earnings results, has made a case that enough things might be getting better to offset the degree of uncertainty. I'm pleased to say that John joins us now. I'm pleased to say Mohammed is still with us. John, I want to start with, not next year, I want to start with last year. 12 months ago, you and I having a conversation, and the average price target on the street for the S&P 500 was 4,000 year-end this year. 4,000. We're almost 20% above where people thought we would end this year. John, before we get into 2024, I think we have to talk about what people got so wrong in 2023. You were bullish, you were lonely, you end the year with lots of company, but what did we get wrong?
Well, great to be on the show, John. I've got to say that I think what happened is people didn't trust the Fed. They didn't recognize that the Federal Reserve showing extreme sensitivity in the process of a rate hike cycle, so that as it practices its mandate to establish a good economy and low unemployment, or essentially full unemployment, 3 to 4%, whatever, depending upon the particular period in time you're looking at. They thought that the Fed was going to disregard that and just go for the inflation. And it would appear that Jerome Powell really took a page out of Ben Bernanke's new Federal Reserve approach that started and continues in that legacy. And the sensitivity the Fed has shown gave us a job market that is very well, is running nicely. Consumers, even as they slow their spending, still spending, and businesses being remarkably resilient through, if you look at third quarter earnings and even second quarter earnings.
So, John, next year you're still constructive. The bad stuff didn't happen. The good stuff did. Can you tell me how dependent your new call for next year is on rate cuts from this Federal Reserve? How dependent or independent is it of what happens at the Fed?
As you know, John, our thoughts on this are that the Fed might very well not cut rates until the second half of the year, and might even do it perhaps as late as in the fourth quarter, and might only do one. We think the Fed is very much committed to getting to that 2%, or at least having that as its target. Okay, I don't know where they'll finally end up, if a little bit over that, but I think they're very much committed, because Jerome Powell does not want to be remembered as the predecessor of Paul Volcker was. I mean, that was a very unfortunate chairman, because it required Volcker to take extreme draconian measures. And when you look at it, this is not the case. This is very much a modern Fed, highly communicative and sensitive, but still concerned about inflation. And you just don't want to go back to the late 70s.
So, John, if I heard you right, you think the Fed may not cut till the fourth quarter. You think we may only get one cut. The market thinks we're going to get 6 cuts. The market thinks it's going to start as early as March. If you are right, doesn't that imply that we see some pullback in this rally?
I think so. Mohammed, we had a 4,400 target for this year that we put in last December. It was realized at the end of June. By the end of July, we saw the way the market was running. We even went up as high as 4,900. And then when we saw that pullback that occurred, we moved back to the 4,400. We were looking for about a 7% upside from where we had been at the lows when we were around the 4,100 point, sometime around late July, as I recall. So when I look at it, I would think that we could get a bit of a pullback in here, but I still think the market closes positive for the year. 4,400 or above that looks good to me, but I don't think we're going to 49. I don't know, we may see 48 in the next few days, but we're not finished with the year. And the concerns you and some others express, and myself, it just looks like we've gotten a little bit too exaggerated. It doesn't mean we're not positive on equities. It's just that markets can get ahead of themselves. And if we don't just trim a little bit in here, we may see trim early in the first quarter of next year.
So people listening to you, and they'll be listening to you very carefully after your great call for this year, congratulations, are going to try to figure out, is John telling us to take some chips off the table for now? Or is John telling us just stay invested, fasten your seatbelt, it'll be fine?
It's the latter point. It's stay invested, know what you own, know why you own it, and have right-sized expectations of how it's going to perform. So the emphasis is on quality. Whether you're in large, mid, or small caps, focus on the quality issues, we would say, and remain diversified. So, hopefully they picked up some of the 5%ers in the treasuries when we were at those levels. That would help diversify a portfolio, and you still have good yields available in tax-frees and in corporates. So,
John, I'm guessing when you say remain diversified, you don't mean own the market weight S&P 500. What would you be doing? Stock specifically?
We like to be selective. Our emphasis remains on technology, on industrials, consumer discretionary, and we can't help but like financials in here. We think the financials are beginning to heal from that scare that they had in March, which impacted the large cap financials. We're still cautious related to the regionals, but we think they've avoided a systemic problem. It looks like that was all idiosyncratic. So we we like financials as well. We think those are good places to be right now in terms of where we expect outperformance moving into next year, and we think they can weather any kind of storm we experience.
We've seen the outperformance there over the last couple of months, that's for sure. John, we've got to leave it there. Great to catch up, buddy. Enjoy the Christmas holidays. John Salford's there on the latest. The banks have rallied so hard, 25% higher over the last couple of months. Mohammed, just a quick word on that. Do you think we've left behind the problems of spring? Have we left that behind?
Well, I don't think the problem of spring was systemic. There were a problem with a few banks. Have we left behind the possibility of a few banks still mismanaging their balance sheet? No. But the banking system was sound. The banking system is sound as a whole.
Big rally over the last few months for the financials on the S&P. Mohammed's going to stick with us. Coming up on this program, Houthi attacks threatening global trade in the Red Sea.
Every week that transit through the area is difficult, will have a big impact on trade flows and big impact on freight rates because, as you know, we will have to sail around the Cape of Good Hope.
Team coverage up next.
Every week that transit through the area is difficult, will have a big impact on trade flows and big impact on freight rates because, as you know, we will have to sail around the Cape of Good Hope. The first consequence you would see, and we're seeing it already today, is that freight rates will start to go up. Obviously, the second consequence you will see in a couple of weeks from now is that the supply chains will be distorted heavily, a little bit like we saw with the Ever Given and during the COVID crisis.
The Euronav CEO weighing in on volatility in the Red Sea, escalating Houthi attacks threatening to shut down the area's delicate shipping ecosystem, cutting off crucial cargo access to the Suez Canal and sending oil futures soaring just yesterday. The US announcing a new task force to address the issue.
America's commitment to Israel is unwavering, and no individual, group, or state should test our resolve. So in the Red Sea, we're leading a multinational maritime task force to uphold the bedrock principle of freedom of navigation. Iran's support for Houthi attacks on commercial vessels must stop.
Team coverage starts right now with AMH in Washington, D.C. and the brilliant Javier Blas over in London. Javier, let's start with you. Just how delicate, Javier, is the situation currently?
It's very delicate and particularly affecting the container shipping industry. About 50% of the world's container shipping capacity has stopped using the Red Sea. That means also the Suez Canal. And of all the traffic that is bound to the Suez Canal, about 70% of it has stopped using it. Importantly, the announcement overnight from the U.S. administration that a new task force will be formed has been responded by shipping companies with effectively, this is not enough, we need more protection, we need the threat to be stopped. And for now, those companies that they have announced a pause in using the Red Sea, now they are announcing that they will start sailing around Africa in a way permanently until the situation improves.
Anne-Marie, let's talk about the official response. Javier touched on it. What else can officials do?
Well, at the moment, we do have today Lloyd Austin convening a ministerial meeting regarding this as they announce this new task force. But Javier is getting to the point of the fact that many people are shrugging this off because a maritime task force already exists, Jonathan, that focuses on the Red Sea. Now, this new task force will be operating under it. So it begs to question why they just wouldn't use the original one or what the original one is missing. When you look at the members that are joining this new task force, it's the like of Italy, Netherlands, Bahrain. Notably missing is Saudi Arabia and the United Arab Emirates. But we should note the U.S. has a tremendous amount of firepower in the region right now. Dwight D. Eisenhower Aircraft Carrier Group, the USS Carney. The question and the debate right now happening in Washington, and I'm sure as well with Abu Dhabi and Riyadh listening as well, is whether or not the United States will go and have a military attack, Jonathan, on these Houthi militants.
And Marie, how important is it that you have local players join this coalition?
Well, it's incredibly important, which is why a lot of people are wondering why individuals like Saudi Arabia, like the United Arab Emirates, like Egypt, which can lose a tremendous amount of money if the Suez Canal, you do not have the freight going through the Suez Canal and these ships and carriers going through the U.S. Canal, and India as well. Why are they not part of it? That begs a big question because they have a lot to lose if this was shut down.
Javier, do you have an answer to that?
Well, very difficult to convince the Saudis that have been fighting in Yemen for many years and not really getting anywhere, or the UAE, which has also been fighting there and getting absolutely nowhere and being criticized by the West for human rights violations in Yemen. I think that effectively Riyadh and Abu Dhabi are saying, we tried to resolve this problem, we couldn't, we didn't have much support from the West, now the problem is you, so it's up to Washington and the Europeans to resolve the problem. But here is an interesting view, perhaps from London. We are asking what America can do, what the U.S. Navy can do. But if you think about which blocs are most affected by what is happening right now in the Red Sea, that's not the United States. It is China, which is exporting to Europe via the Red Sea. So after all, this is a problem for the European Union / the United Kingdom and China / India. And neither side is really making much contribution to what the United States is trying to do on the ground, or better, on the seas in the Red Sea.
Such a good final point. Javier, thank you, sir, for being with us. The brilliant Javier Blas alongside the excellent Anne-Marie Hordern down in Washington, D.C. We're going to wrap things up with Mohammed next on the programme, get some final thoughts on 2023 and look ahead to 2024. In your equity market right now on the S&P, positive by 0.3%. Final thoughts with Mohammed and your trading diary up next. Stocks higher, 25 minutes into the session. Let's get to the trading diary. The day ahead looks like this. Atlanta Fed President Raphael Bostic speaking at 12:30 Eastern, plus FedEx reports after the closing bell. Thursday, US GDP and another round of jobless claims, followed by quarterly results from Nike and Carnival Cruise Lines. Friday, the US bond market closing early for the holidays. Before we run away for the holidays, just a final word with Mohammed Al-Erim. Mohammed, looking back on 23, looking ahead to 2024, one big last thing for you. What's the big risk for next year from your perspective?
I think it's both a risk and an opportunity, which is volatility that causes more dispersion. You know, John, we've banked early the major supportive top-down factor, and that is that the Fed would pivot to loosening and considerable loosening. Well, we've banked that. That is what's pushing us and will continue to push us for a while. The what next is not going to be a top-down factor. It's going to be bottom-up. So more volatility and more dispersion.
Mohammed, thank you for today and for the whole of 2023. Thank you, sir. Appreciate it as always. Enjoy the holidays from New York City. That does it for me. Thank you very much for choosing Bloomberg TV. This was the Countdown to the Open. This is Bloomberg.